Welcome, and thank you so much for joining us today for our quarterly economic summary. My name is Kara Bloomberg, and I'm the Chief Operating Officer of Landrum HR, the parent company of HRQ. For those that are not familiar with HRQ, we are a professional services firm with over 20 years of serving clients across the country. Our expertise is working with executives with 3 integrated services: enterprise-wide human capital consulting, providing interim HR talent, and conducting searches for HR professionals. Our consulting team brings a depth of experience in workforce planning and analytics, talent management and talent strategy projects, org design, and HR transformation needs. In 2019, HRQ joined forces with Landrum HR, who is a 50-year-old privately held business, and together we provide end-to-end talent solutions for our clients. Our other service lines include worksite management, a customized labor solution for companies that use large numbers of temporary workers. We also provide PEO services that include payroll, benefits, workers' compensation, and HR. You can find more about all of our services by visiting our websites, landrumhr.com and hrqinc.com. A recording of this webinar will be sent to everyone that registered today. Please feel free to ask us questions, and Brian will try to get to some of those questions at the end of his presentation. And you can use the question pane in our control panel. There'll be a quick survey that pops up as you exit the webinar today, and we'd love your feedback and would appreciate it. So it's my pleasure to introduce Brian Wilkerson. Brian has held senior leadership roles in both enterprises and global consulting firms. He is a successful entrepreneur, having founded and led a consulting and software company that was sold in 2007. He's a deep specialist in driving innovative strategies and using cutting-edge planning techniques. He's worked around the globe. Brian is a frequent invited speaker and is sought by the press for his insight. He's authored a number of articles and book chapters. So Brian, my favorite webinar every quarter. Looking forward to hearing all the information and how rapidly things are changing in the workforce. So I know it's going to be a wild ride. So I'll hand it over to you.
Great, thanks, Kara, and we'll try not to disappoint. There is lots of economic news, lots of things to talk about today. Before we get started, I wanted to briefly acknowledge Julie Stanek, who's one of our lead researchers and is the driving force behind a lot of this economic data and pulling these things together. So we do these quarterly economic webinars. We also do a quarterly summary that we send out. And so contact us if you're not already on that list, but Julie does a great job of pulling all this information together. So I wanted to briefly say thank you to her before we get started. To kick things off, I wanted to start by taking that high-level look at GDP. When you look at the chart, you can see quite a dip there in GDP as we went through the throes of the pandemic. And the good news is that we're starting to see some rebound. So when you look, in Q4 of 2020, we had a 4.3% increase in GDP from the previous quarter. So that was good news. We saw a lot of improving economic activity. We're still about 460 billion below where we were in Q4 of 2019. So you can see where we ended up on some of these charts where we had some pretty big dips and the lines are starting to recover, but we're not quite fully into recovery just yet. When you look at the definition of recession, it's really defined by changes in GDP. It looks like the recession has ended based on both the numbers that we saw in Q4 as well as what we heard today, which was the preliminary release of Q1 GDP numbers. Right now, it's looking like about a 6.4% increase in terms of overall GDP, which is higher than we saw in Q4 and definitely pointing us in the right direction in terms of trends. When you start to look at some of the numbers underneath that, the increases in GDP came in 2 major categories from the preliminary analysis. One is personal consumption, which is certainly good news, people starting to get out and spend again and return to some economic activity. The other factor was around government spending, which, while that's great from a short-term economic stimulus perspective, there's certainly lots of questions about the sustainability of that over the long haul. So great to see those numbers moving and trending in the right direction. We're glad to see that increase in GDP and that trend continuing. We want to make sure that that's really sustainable and that we start to see pickup in other sectors rather than just government spending. So it's great to see some increase in personal consumption as well. To break down that 4.3% increase in Q4 that we saw even further, when you look at the chart here, you have the breakout of the different contributions to the GDP component. You can see that we had both increases and decreases depending on what you're looking at. So in Q4, we saw an overall increase of about 4.3% in terms of services spending, but we saw decreases in both durable and non-durable goods from an overall GDP perspective. The increase in services spending was enough to overcome the backslide in those goods spending categories, but still causes us some concern when we look at that. We'll see what the Q1 numbers look like when we get the full report and the final report, but still some caution in terms of looking at durable goods spending. From a business investment perspective, we basically saw pretty similar numbers to what we had seen previously in terms of residential and non-residential investments. We saw a little bit of decrease in government spending in Q4 of last year, about 0.8% decrease. That was both in the federal and the state and local. Exports continue to be, we continue to be a sort of net importer in terms of bringing goods from other places, and so that's a bit of a drag on GDP as well. But overall, some positive signs in terms of increases. And again, we'll see what this looks like for Q1, and hopefully we start to see some sustainable increases in other categories as well. To break down and start looking at then the labor force, we're seeing some returns, but those returns are slow. So when we look at the labor force, we look at a number of different factors. We look at labor force participation, we look at unemployment, and we look at both the overall unemployment rate, which is the number that you typically get here on the news and on the radio, and we also look at the U6 number, which looks at not only people who are unemployed, but basically people who are underemployed, working part-time, who would rather work full-time, et cetera. So a little bit more comprehensive of a picture. When you look at the numbers overall, we've had a bit of a decrease essentially from December 2020 to March 2021 in terms of the overall available labor force. When you look at it, it's about a drop about 9% in terms of the overall labor force participation rate, the overall civilian labor force. And then the labor force participation rate was basically even from December to March. So the lowest point in terms of labor force participation, people who could work, who are working, is 60.2%, which was in April of 2020. We're at about 61.5% now. From an unemployment rate, we are seeing a decrease in the unemployment rate, which is a good thing. So our high point for the overall unemployment rate was 14.8% from a standpoint of overall unemployment. That was April 2020. In December, it was 6.7, and in March, it's 6.0. So the unemployment rate improved by about 0.7%. Certainly good news. And then when we look at the U6, we also saw some improvement there. The worst of that was, again, back in April of 2020, when we were at about 22.8% in the U6 unemployment. We went from 11.7 to 10.7 between December and March. So we've gained significantly from the overall low point, and we are continuing to see incremental gains quarter to quarter as we look at it. So 0.7% and 1% are not necessarily anything to write home about, but they are showing a steady improvement in terms of the overall unemployment rates and things getting better. We'll break these numbers down further as we dive into it as well. When we look at unemployment by gender, there's a number of different trends to look at, and many of these have been in the news, and so some people are probably familiar with some of these trends, and we are starting to see some good news here. When you look at where we were prior to the pandemic, the percentage of the labor force that was unemployed from a gender perspective matched up to sort of the participation in the labor force. So back at that time, essentially the men were 52.9% of the labor force and women were 47.1%, and those were the same proportions in terms of unemployment. We've had some shifts in that over time. So we had in April and May of last year, there were more women who were unemployed than men, even though there was less participation from a workforce perspective. What we're starting to see now, we're getting back to in March 2021, pre-pandemic proportions in terms of women are actually now slightly less likely to be unemployed, but we're starting to get back to that unemployment rate being similar to the participation rate. What that really means is that we're not seeing sort of a systematic imbalance in terms of impact from an unemployment perspective. From a race and ethnicity perspective, and we've talked about these numbers before, we continue to see some issues in terms of disparity when you start to look at it by race and ethnicity. So on this chart, the green line on the left-hand chart is the percentage of the labor force that each race represents. The darker line shows the percentage of the unemployed that those races represent. So when you look at whites, for example, you see that they have less unemployment than their overall participation rate. Opposite for African Americans, who are seeing higher unemployment than their participation in the overall labor force. Similarly, when you look at Hispanic versus non-Hispanic, you see that Hispanic has a higher percentage unemployment than their participation in the labor force, and vice versa in terms of non-Hispanic. So from an overall equity perspective, still some concerns when you look at the data in terms of race and ethnicity and disproportionate impacts that we're seeing in terms of overall representation in the labor force and who's being hit the hardest by unemployment. So certainly these are things that are concerning, and we want to continue to watch in terms of those disparate impacts. When you start to break down the unemployment by gender a little bit further, oops, sorry, I went backwards there. When you start to look at some of these trends and break them down a little bit further, the unemployment rates are highest for African American men and African American women. So that's obviously, when we look at those rates, it's a concern, and you can kind of see on the chart on the bottom right-hand side the differences between participation in the labor force and unemployment rates. The one piece of good news that we have on this is that we're at a point where earlier in the pandemic, we had about 4.2 million women who had left the labor force. That number has dropped significantly to about 2.4 million. So that's improvement, but obviously 2.4 million is still of concern, and it's an issue that needs to continue to be looked at. A number of the reasons that have been cited in terms of availability of childcare, school responsibilities, et cetera, are all still factors that need to be looked at when we look at things from an equity perspective. When we look at it, there's African American women are still quite a bit lower than they were in terms of December 2019, and also Latino women are 3.2% less in the workforce than they were previously. So all of these things are concerns from an equity perspective that, from an overall policy perspective, we need to continue to look at. 1.7 million white men have not rejoined the labor force. Latino men are the only group that have actually sort of increased in numbers when you look at where they were pre-pandemic versus now in terms of an overall labor force participation rate and where they are versus unemployment. A lot to go through. I know there's a lot of numbers there, so if folks have questions, feel free to ask those and we can address those at the end of the presentation. One of the things that we also track are reasons for leaving jobs and try to see what trends there might be there. I was doing another webinar earlier this week and heard at that point what we're hearing in a lot of places, which is we're starting to see more people leaving jobs and taking other jobs, moving between jobs, et cetera. So one of the things that we tend to look at is separations or people leaving one job and going to another, and why are they doing that? So when you look at this graph, the blue component of the bar is people who quit. The green portion of the bar is layoffs and discharges, and the black percentage is other. So when you look back at March and April of last year, layoffs and discharges were disproportionately the reason why people were leaving the job that they were in. So in March of 2020, 80% of the separations were from layoffs and discharges. That number has gone down quite a bit, as has the overall number of people who are leaving their jobs, to about 33%. So again, that's good news. What we are starting to see, and this is particularly true if you look industry by industry, region by region, is some increases in the number of people who are quitting. So you can look at that as overall turnover rates are starting to increase in certain industries, certain geographies. And a lot of that has to do with where they are economically, et cetera. But we are starting to see more mobility and more people moving within or between organizations. One of the factors that we've heard in a number of cases is driving this is, in some cases, workers may not have liked the way that their organization dealt with the pandemic or how they addressed some of the issues associated with that. And so now that they have other opportunities, they're leaving and moving on to an organization that they feel, aligns better with their philosophy in that respect. So not a panic button in terms of the number of quits increasing significantly, but we are seeing some trends in different geographies and different industries that indicate that we may be in for more of an increase in turnover in organizations. Another metric that we look at is the duration of unemployment. How long are people staying unemployed? In March 2020, about 16% of the unemployed were out of work for 27 weeks or more. That number has grown quite a bit as we look at it, in terms of now it's about 43%. So while we are seeing some improvement in unemployment and things getting better, we still have this nagging issue of people who are unemployed being unemployed for quite a long time. So this is of significant concern, both from an overall economic perspective and an equity perspective, and something that we want to make sure that we continue to track. But as you start to look at policy responses from, things like stimulus and, programs for workers who have been unemployed, et cetera, there continues to be a risk of financial drain from, the long-term unemployment component, and how can we start to systematically solve that? So this is an area of concern from an overall economic perspective that we want to continue to keep an eye on. We have been tracking for quite a while some of the household surveys and other kinds of pulse surveys that look at not just the economic numbers associated with the pandemic, but what are the impacts on people in terms of, security and stability and things of that nature. So I want to spend a few minutes going through how this has changed since the last time we did this. In this chart, the blue circle is essentially what people said in January of 2021. And then the green circle is what they said in, the end of March in 2021. So one of the things that they ask about is how many people expect that there will be a loss of employment income in the next 4 weeks. The good news on that front is about 27% of people were concerned about loss of income, and that's reduced down to about 17.4%. People are feeling better about where the economy is and the stability of the work that they do have. So that's certainly good news. An interesting trend is that we are still seeing a significant percentage of the workforce commuting and doing telework for work that was typically in person. That number hasn't changed much. It's in the 38, 39% range across that, but that's quite a bit of the workforce that is obviously in a telecommuting situation. And again, the qualifier on this is that work that was typically done in person that's now being done by telework. So those are pretty big numbers when you look at that. More good news in terms of food scarcity. That's gone down from 11.3% to about 8.8%. So it's good to see some reductions in there. Of course, we'd like that number to be zero, but as we look at it, we are starting to see some improvement in terms of food scarcity as an issue. Similarly, on housing insecurity, basically not being current on rent or mortgage payments, that's gone down a little bit as well from January to March. Uncertain on how much of that is related to stimulus or other government programs that might be influencing that, but at least we're seeing some improvement in that area. The other trend that was very interesting during the pandemic was that many people were changing their plans for post-secondary education. deferring college and going into the workforce, or other kinds of changes that they were looking at. That number in terms of people who have created or experienced changes in their plans has also gone down. So it was very high, 80.7% in January, and we're starting to see those numbers come down a bit. Lots more behind those in terms of what people are choosing to do and what they're looking to do, but it's interesting to see that that number is at least starting to come down. In many cases, there were people who were looking to defer college altogether and go directly into the workforce because of the economic impact. So this is an area that we'll continue to look at and continue to see what some of the trends are and some of the detail behind this data. So I know a number of these webinars that I've done, I haven't had very much good news for people, but as we look at this, we are starting to see some improvements in some of these numbers. And I think that a lot of these things that have very real and human impact to them are areas that we want to pay particular attention to. And it's good to see some improvement. We are starting to see some comeback in jobs, and obviously that plays out in terms of the unemployment rate, but just another perspective on it. So when we look at it, we had from May to August, we saw a more significant increase in job gains. So basically increased about 10.8 million. September to December, we saw about 1.3 million. And then this quarter, we're starting to see, even a slight improvement over what we saw September to December. So 1.6 million in terms of the increases in non-farm jobs that were out there. When you look at it, these numbers are variable, really variable. So when you look industry to industry and sector to sector, the changes are all over the place in terms of people gaining, then losing, et cetera. And a lot of companies and industries are really struggling to find what are the right levels of staffing, what is the quote unquote new normal in terms of where our staffing levels should be. And so we'll continue to see fluctuation in those numbers as we go through, and hopefully we get to a sustained positive trend. But we expect that there will continue to be some fluctuation and some chaos still industry to industry as companies try to figure out what the right staffing levels are going to be for their level of economic activity. To dive a little bit further down into job gains for the first quarter, and again, this is specifically in the first quarter, from a goods producing perspective, we had about 132,000 increase in jobs. The primary sectors there are mining, construction, and manufacturing that created those jobs. The total overall in services was, really one of the biggest gain points. And that was across kind of a wide spectrum of different sectors. So leisure and hospitality, as more places are starting to open, restaurants coming back, et cetera, we're seeing increases there. Professional and business services and education, we're continuing to see increases in transportation and warehousing. That's pretty much been a trend throughout the pandemic. And as soon as we started to see any sort of recovery or any sort of improvement, that was a sector that was increasing. Wholesale trade and retail trade are both starting to see some increase as well. So again, that lines up to what we're seeing from an overall GDP perspective, people increasing personal consumption, starting to get out and spend more, et cetera. And the sectors that are really creating the majority of the new jobs, fall along those lines. So as the economic activity increases, we're seeing those gains from a jobs perspective. Government was a contributor as well in terms of 157,000 additional jobs in terms of state and local government. Again, great to have some new jobs, but how sustainable is some of the government spending in terms of the long term? And so as we look at that, that's certainly an area that we'll watch closely. Job openings, just another chart when you look at it, and this is just more sort of an overall graphic representation. You can see the green lines are the total number of job openings that are out there, and then the blue line is kind of a 12-month moving average trend. You can actually see that we're starting to see some slowing in terms of the number of job openings that are out there, and supply and demand matching up a little bit more as we look at it. But we're much better than we were in terms of the total job openings and some of the big dips that we had in the early second quarter of last year as the pandemic was in its full throes. And so we're starting to see some good numbers in terms of this area and the overall number of job openings increasing. So hopefully that continues to make a dent in unemployment and make improvements in that area. From a standpoint of self-employment, one of the things that we try to look at is what are people doing as, as overall employment changes, where do we end up from a self-employment perspective? Typically in recessions and other kinds of economic downturns, you see that a number of people move to self-employment, not necessarily by choice, but because, that's kind of the option that they have. When we look at the numbers, we are at sort of a low from where we were, in 2002 through 2008, and we saw some huge dip in terms of the front part of the pandemic. But we're starting to see some increases in self-employment and those sorts of things, and but a lot behind that data, of course. But we are seeing an increase in sort of self-employment by choice, which is good news. We're also seeing that people who and sometimes in recessions would move away from self-employment and try to get inside of companies, some of the economic safety net that was created around unemployment for self-employed and things of that nature have helped keep people in the self-employed workforce. So seeing some pretty steady trends in terms of overall self-employed. So another pulse survey, but this one focused specifically on small business, some interesting results in terms of that. So when you look at, again, same numbers, January is the blue and April is the green. The small businesses who plan on hiring new employees in the next 6 months has increased from 23%, almost 24% to 32% almost when you look at it. So the organizations are feeling more optimistic in terms of their ability to hire. Also, it's the number of companies who have decreased their number of employees in the past week has gone down about 5%, from 12.5 to about 7.3%. So again, good news in terms of that. The number of, and you would expect this, the number who have increased employees has actually grown, pretty significantly as well. So from 2.7 to 7.9. To start to see that improvement in people who are increasing the number of employees, very encouraging sign. And that's one that we'll continue to watch very closely in terms of what small businesses are doing from an increased employment perspective. When you look at this, though, there are some bad news pieces. So when you look, for example, at companies who have experienced domestic supplier delays in the past week, that number has increased. You've probably seen a lot of news articles around shortages of computer chips, plywood, things of that nature. And there continue to be a lot of concerns from a supply chain perspective. And there's a lot of factors that go into that. We could do a whole webinar on that piece, but starting to see, numbers showing that people are experiencing delays. The last number on here continues to reinforce that. So the number who have experienced delays from foreign suppliers went from 8.8% to 11.5%. So these numbers are certainly concerning. These are only looking at small business. As we continue to work with large companies, we're seeing a lot of continued delays in a number of different sectors. And most importantly, what we're seeing is that those delays are actually causing either lost revenue or changes in production plans for companies because of the inability to get supply. This is very concerning from our perspective because it could lead to a slowdown in job recovery or a reversal in some of those numbers that we're seeing that are trending in the right direction because of the inability to get supply and because of some of those shortages or scarcity or delays. And so all of those things are pieces that we want to continue to watch closely because they're really a risk to that overall economic recovery and continued growth. Some numbers to think about. We go through these each time. Overall, we have seen an increase in the hourly earnings of workers in the United States. As I mention almost every time we have this webinar, while that may seem like a good thing, there's some important things to understand behind those numbers. A lot of what we're seeing is an actual systematic elimination of lower paying jobs. And so as we add jobs, they tend to be in higher paying categories. And so while it looks like workers are earning more, it's actually more of a systematic shift in terms of the type of jobs available. Overall, the net improvement in earnings is a good thing, but we also have to be careful to think about, those who might be left behind in terms of, do they have the skills for some of the openings that are available and the things that are out there. So you always have to look at that number with a little bit of caution. One of the other ones that we look at is the annual percentage change in employment cost index, which tends to look a little bit more towards what are companies having to pay in terms of salaries and things like that. So in some ways, it's a number that I look more to in terms of what's happening with wages and employment costs overall. So that one is up about 2.5%. One good news piece is that we're seeing the consumer confidence index for March at almost 110%, which is the highest level since the beginning of the pandemic. So we're starting to see some good improvements there, and consumers feeling more confident about where they are and what kinds of things that they should see. The consumer price index for March was about 0.6% increase. Right now, we're looking at about a 2.6% annual increase. So this looks at the cost of, the goods that people are buying. And so obviously that's a number that we want to pay close attention to. We don't want to be in a place where there's too much inflation, things of that nature. So we really want to, pay a lot of attention to that particular number, because if that starts to get out of control, it obviously starts to undermine some of the gains that we might get from an overall wage or, other kinds of perspectives. So not overly concerning right now, but something we certainly want to keep a close eye on. From a leading indicators perspective, we look at a number of different things, and we're getting kind of mixed information in terms of that. So we're seeing a continued decrease in the overall commercial construction spending, and that's a trend that has some concern, because we obviously want to look at where are things going overall, and we want to continue that continued economic recovery. Usually that commercial construction spending sort of gives an indicator of where we're heading from a long-term perspective. So to start to see some decreases in that area obviously cause us some concerns, and that's something that we'll continue to watch. We're also starting to see a slowdown in the number of single-family units that have been sold. Now, we've seen obviously an increase in the mortgage rates, and as that's gone up, we're starting to see some decrease, or at least a less aggressive, buying and selling in terms of housing. This varies quite a bit when you look across the different sectors of the country and the geographies in the country, and some housing markets are still relatively hot, but not to the degree that they have been in the past. So this is an area, both of these give us a little bit of pause in terms of where we are from an overall trajectory, long-term recovery, and just want to make sure that those things keep trending in the right direction. From a durable goods perspective, we're seeing a bit of a pullback in terms of durable goods orders, another one of the leading indicators that we tend to look at as we look at things. It's still 3% higher than it was a year ago, so that's good news, but we are starting to see a slowdown in terms of overall durable goods orders. So again, as we look at some of the leading indicators, there's a few causes for concern, or at least caution, in terms of making sure that we are going to be able to sustain some of the recovery and some of the improvements that we're starting to see. So these are all things that we're watching, and there's not enough here for me to really sound a lot of alarm bells yet, but it's enough to say let's keep an eye on it, and let's make sure that we're clear on where all these things are going. So when you translate that down to what should companies be thinking about now, some of this is going to be a little bit different from things that I've talked about before, because as you look at it, we're moving into a stage where companies really need to start looking at the where they're heading long term, and start to look at more sort of what I would call systematic recovery efforts and systematic improvement efforts in order to be prepared for the new normal and anything else that might hit us in the future. So to start with, it's really important to be looking at resilience and agility in the organization. How well prepared is the organization to deal with the ups and downs that we're going to continue to experience, other shocks to the system that may become, et cetera. It's really time to sort of step back and look at the lessons that we've learned from the pandemic and start to create sustainable change where we can make sure that we're prepared for whatever might happen, whether it's as dramatic as the pandemic or, much smaller components that we need to look at. So supply chain and human capital are both areas that are critical to look at. We continue, as I mentioned earlier, to see issues with supply chain and reliability, delays, all of those components. And so that's obviously something that's very urgent to address. But even thinking about human capital and supply and demand in terms of that, we really have to look at our organizations and rethink how we staff, deploy, et cetera, and think about how can we increase our overall organization resilience and our agility in the human capital space. The second thing is looking at employment brand and employee value proposition. The pandemic has changed every company in one way or another. Some maybe to a lesser degree than others, but all of our companies have changed in ways that are going to continue to ripple through the organization. Whether it's how we staff, where we work, how we work, who we work with, equity and inclusion issues, all of those components have really changed who companies are. It's time for companies to step back and consciously redefine who they are and what they want to be in terms of their culture, their employment brand, that sort of thing. So all of those pieces are really important for companies to step back and take a pause and look at and be very conscious about that. Along with that comes, who are we to our employees? What do we offer to work here? Why come and work here versus other places? Those are the kinds of things that we really want to be thinking through and be very conscious about. And now's really an ideal time to do that. Workforce composition and cost. When you look at workforce composition and cost, this gets into not only how many sort of people do we have overall from a staffing perspective, but how many of those are employees versus part-time versus contract versus contingent? Where do we build flexibility into the segments of the workforce? Where do we create, sort of the ability to scale up or scale down very quickly from a workforce perspective? Where does it make sense to, have that variable labor cost versus more of that fixed labor cost? This is not just a tactical exercise of planning, how many people we're going to hire or not hire next year. This is really more of a strategic reassessment of how we get work done and thinking about what kinds of permanent changes we might want to make to that. And again, we have to step back and take the lessons that we learned from the pandemic and apply those to our workforce composition and where we want to head with that. So this is a very strategic, sort of systematic look at how we staff and how we get work done. Key talent retention and knowledge loss risk. I mentioned, for example, that uptick that we're seeing in some industries and some geographies in terms of turnover and people voluntarily leaving organizations. It's a good time to really step back and think about who do we have that we want to retain from a critical skills, high performer perspective, high potential perspective, but also places where there are risks of key knowledge loss, key customer relationships, things of that nature. Any place where, the departure of an individual or a set of individuals could really hurt the business, and think about what are we doing to address some of those risks and how do we sort of make it and, make that piece more sustainable as we look at it. So knowing where your talent is, knowing what you can do to keep them and addressing that is also important. Lastly, what do we do from an investment perspective? Where do we make strategic investments that help position us better going forward? A simple example of this is we've seen a dramatic increase in merger and acquisition activity. Companies who have the capability to actually, conduct these types of transactions are taking advantage of where the overall economy is and where certain sectors are to make strategic moves that are either offensive, to try to create new capabilities or expand in certain ways, or defensive in terms of protecting them from competitors or consolidating their industry or those kinds of components. So again, taking a very strategic look at where you are and where there are opportunities. That doesn't necessarily have to be a transaction where you're buying another company, et cetera. It could be acquiring strategic talent or strategic capabilities that move you into a direction that you need to get to. It could be taking advantage of, for example, a key performer at a competitor who isn't happy with, where their company has gone, or some of those things, and actually being able to, take key talent from your competitors. So there's a number of opportunities from a strategic investment perspective that can come up. It's also a good opportunity to think about resetting certain programs or ways of doing things. Performance management, compensation, some of those key talent processes. It's really a good time to think about, are those processes not only suiting who you are, but who you want to be and who you've evolved into through the pandemic. So a lot of these are not sort of the things that you're going to get done next week, but they're really more strategic looks at the business and how do you position it for where it needs to be going forward. So all of these things are key considerations at the leadership level for organizations, and things that we've been working a lot with clients with over the past several months as clients really take a step back and think strategically about where they are and where they need to be. So that wraps up the presentation portion of this, and I will open it up for questions.
Thanks, Brian. Really interesting as I look at the questions that have come in. Definitely from a geography perspective, you can tell that companies are kind of thinking differently based on where they are today. So I'll ask you two questions and that are pretty radically different, but kind of the same in nature around COVID. So, first question from an attendee is, hey, we think COVID's pretty much going away. Why should we be focusing on all of these changes if we're going to go kind of back more to the norm prior to COVID? So we'll start with that one.
Yeah, I think it's a good question. And I think that, as we see increases in vaccination rates and things of that nature, there is a temptation to think, oh, we're returning to normal. But the truth is we're not. And the reason why we're not is because attitudes and perceptions have changed, and they've changed in a permanent way. So the experiments in some cases, or the continuation in other cases, of working remotely and different ways of working, et cetera, are now embedded in the fabric of companies and, more importantly, employees, right? So we see, for example, in preference surveys, a strong preference on the part of employees to have remote work be a continued significant portion of how work gets done, versus in many organizations and many industries, leadership feeling like we should go back to full-time in-person kinds of ways of working. Well, that's going to come to a head, right? The piece that I talked about in terms of the ability to work remotely, and the people starting to leave and move to organizations where they feel like they're more aligned. We're seeing these almost systematic shifts. So, for example, I live in an area that is very much a tech hub. Well, many people who would have liked to have worked for Silicon Valley companies, for example, didn't have that opportunity unless they moved to Silicon Valley. Whereas now they're seeing a lot more openness for people to work full-time remote, leverage best talent across the country, wherever it is. And through the pandemic, people have learned ways to make that work. That's a really long answer to say that I don't think we are going back to just the way that it's always been before the pandemic. There's enough systematic changes in the way that people have worked and their attitudes about work that every company, to some degree or another, is going to have to address their philosophy, their stance, their way of working, et cetera. If they don't, frankly, they're going to start losing talent to the companies who do. And so it's important to really consider that, even if, a month from now, there's no more COVID anywhere, which probably isn't going to happen, but even if it did, I think that we have such systematic shifts in organizations and worker attitudes that every company's got to address them in one way or another. Not to mention that there will be a next thing. It may not be another pandemic, but there will be a next thing that comes in and disrupts us from an economic perspective, from a workforce perspective, and we need to be ready for those things as well.
Hey, your answer kicked off a lot more questions here, so we're going to try and get to those, but some follow-up questions. But I want to swing the pendulum all the way over to the other side of this attendee who's saying, "Hey, our company is thinking about more lockdowns, about additional spikes that could happen, and what should we be thinking about as we prepare for those?"
Sure. So there are some risks out there, right? So the COVID-19 variants that we're starting to see in certain places are a big wild card, right? And even if domestically we are able to avoid some of those impacts, lockdowns, things of that nature, on the international scene, as many people have read, there's still quite a bit of chaos that's going on around the world in terms of spikes, and some countries looking at that. If you look at what's going on in India today, for example, India is still a very key trading partner. We have a lot of offshore operations from companies that are in India, and there's significant impacts in terms of that. So even though we may not end up with lockdowns in American cities or those kinds of things, we could see continued disruption because of the global interdependence that we have. And we could see the impact of variants here in the United States continue to hit us and create even regional impacts, maybe not, full country impacts, et cetera. So when we
Right.
look at that, I think the big thing is that we have to think about all the things that I was talking about before, right? Workforce composition, how we're doing our supply chain, how we're doing our human capital, et cetera, and think in terms of the what ifs. What if we do experience those pieces? And that doesn't mean that we have to panic and overreact, but we should have the right plans in place for what happens if we do experience additional lockdowns or slowdowns or things of that nature. What if we do see a variant that starts to spread more regionally or whatever it might be. So I think it comes back to that, stepping back and doing some of that planning to be prepared for whatever comes. That also includes what if we kind of go back to normal and we start to see some great growth and those trends continue. How do we deal with that as well? So I think being prepared for both sides of the equation is really important.
Yeah, and great point you were making about being prepared for the comeback as far as companies are ready. We're seeing some trends moving forward, but now we've got concerns about supply chain. So how does that going to progress? So I think continuing to hit on that seems like that's a big area of concern for our attendees. So the next question that came in is related back to your data on commercial construction, and just what are your thoughts about as companies are reevaluating their needs for physical office space, are employers impacting commercial construction in your opinion, and is there a way to see kind of more data around that?
Yeah, great question. And I think that it is one of the most prevalent topics of conversation that we're having with clients right now is real estate and footprint and what should that look like going forward. So we're seeing some companies take what I would call maybe a less strategic approach and saying, you know what, we have all these people who are working remotely, so we can just reduce our facilities, right? And not
Yeah.
necessarily thinking about where do we want to be long term, et cetera. And certainly creating some cost savings and things like that. But other companies are really taking a much more careful approach and saying, we know things have changed, we know that our needs have changed, and we know that there are market forces that create some opportunities for us in terms of real estate. So we're seeing some companies, simultaneously divest certain real estate assets while investing in others as they really think about what they want things to be going forward. I do think that the commercial real estate piece from the data that we've seen is going to run into some hard times over the next year or two as people really figure this out. And in some cases, are coming to the end of the lease and they'd rather just get rid of it than, wait to figure it all out. So I do think that we're seeing that. The data that we're starting to see is around, a lot of facilities management organizations, a lot of real estate organizations, et cetera. And a lot of it, I think, is the tip of the iceberg in terms of we're seeing trends that say, people are shedding real estate, et cetera, but we aren't seeing, these huge systematic downturns as of yet. I think that in the next 90 days, a lot of companies will finalize what their strategies are in terms of kind of what their workforce is going to look like long term, how much is going to be virtual versus not. That's when you're going to see the dominoes start to really move in terms of what's going to happen in the commercial real estate market as people start to act on those strategies. So I think we're still a little ahead of the curve, but we're getting there pretty quick.
Yeah, good information there. And what should we be thinking about now, as you always do, trending a bit away from just traditional HR, but you mentioned a lot of activities that are beyond the traditional HR, and how important are these versus all of the people-focused actions that you talk about?
Yeah, I definitely think it's an and, right? Supply chain versus human capital, for example, is a good test case, right? So if we build our human capital plans for certain levels of production, but yet we can't get the materials in order to be able to do that production, that's an issue, right? We've seen, for example, in the auto industry, them having to cut production numbers because of the lack of availability of computer chips, right? Not necessarily the thing that people would think would be most important to cars, but obviously today's cars are big computers, right? And so many of these things are synergistic that I think you have to really address both. I think some companies would tend to overemphasize some of the supply chain elements and not really think about the human capital aspects of that, and vice versa. So it's really a balanced approach, and I think many of you are HR professionals, and it's important to be able to have that perspective and participate in that broader conversation about all these dynamics that impact the ability of the company to grow.
Yeah, and really having these conversations internally in what would be considered traditionally separate areas of the business. So great information there. So are we likely to see more direct payment stimulus activity? So I think this came from your unemployment duration slide, and inquiring how might you think that would impact the labor market?
I think we will see targeted stimulus continue, and while it may not be everybody gets X amount of money, I think we will continue to see some level and some form of direct payment stimulus. It's likely to be more targeted at people who have been most impacted by unemployment and some of those pieces. What I hope we will see is more investment in workforce development. We're talking a lot about infrastructure and things we want to do there, but I think this is really an ideal time to focus on reskilling our workforce and really building a much stronger base of the kind of technology and advanced skills that we are going to need to compete in the future. I think that's an area that the U.S. has generally lagged behind in, and something that this is a perfect time if we're going to invest in the workforce, if we're going to invest on improving capabilities and helping people compete in the economy. That's a worthwhile investment from my perspective. But I do think that we will continue to see some direct payment stimuluses that are a little bit more targeted, but I think actually we'll see them for quite some time.
I'll ask you to kind of build on that about engaging the workforce and taking them to the next level, because question here around the talent shortage that already existed before the pandemic, and hearing now that that's become much worse. So what's your perspective around what companies can be doing? And I think you just answered that in some ways, but I'll ask you to expand there.
Yeah, I think that there's a couple of things. What I was mentioning earlier was sort of some broader, systematic investments that can be made. But I think from a company perspective, similar kinds of opportunities exist. So when we look at the types of skills that we're going to need for the future that are either scarce or just evolving in the marketplace now, it's really a good time for us to be thinking about how do we build those skills, how do we create that, whether it's through skill education or reskilling of existing workers, taking advantage of permanent changes in how we do things and think about how we can move certain workers into other areas. So for example, I know a number of companies have moved towards more automation through the course of the pandemic, recognizing that there was a risk, because of people not being able to work in person and things of that nature. Well, how do we take some of the workers who may have been displaced and really look at building a new set of skills for those workers that align with what we're going to need in the future. So I think there's a good opportunity for companies to think ahead and really analyze what they need from a skill perspective and think about how they can build those now rather than waiting until they're so far behind and then, oh, what do we do at that point? This is the kind of work that we really love doing in terms of helping people predict that future and figure out what they're going to need and how they can build it in a way that's cost effective and sustainable.
Yeah, and staying ahead. So yeah, that's great. You touched on women returning to the workforce, and I know your team is tracking this, and I would expect future webinars will talk about this a little bit more. But the question that came in is, hey, I've been reading an article about this. They are returning, women are returning, but seem to be doing so with lower wages. So what wage impacts have you seen in these reemployment trends? And we may be a little soon here, but what are you seeing so far?
Yeah, it's a great question though, because as we're starting to look at some of the leading data that we can get, it absolutely is a concern. And I think that we're seeing in a number of cases a big shift in terms of the kind of jobs, the pay available, et cetera. And so it's a trend that we really have to watch. And I think some of that comes down to skills, but some of that also comes down to workforce arrangements and flexibility and availability of childcare and those kinds of things. And employers who are serious about the kind of competitive advantage that a diverse workforce can bring and having women in the workforce can bring. There's a lot of opportunities in terms of thinking about your benefits, your policies, the things that you offer in order to be more attractive to women in the workforce. So I think that is the opportunity from a company perspective. From an equity perspective, I think that it's something that we've got to continue to look at. I live in a state where a new pay equity law just came into effect, and not long enough for us to even see what the impacts are, but I think there's more and more of a systematic focus on this, and I think that companies need to be proactive and really look at equity concerns within their workforce. Do you have disparities? Do you have issues that are there? I think there are some companies who are looking at the overall softness in the economy and saying this is a time for us to lower wages overall and take advantage of the softness and sort of lower the cost of our workforce. But that's a little bit of short-term thinking, because as the economy starts to turn around, that strategy will likely backfire. So I think it is a good time for companies to address any equity issues they have, and we need to continue to look at it from an overall policy and equity perspective.
Okay, great. Well, we're coming close to the end of our time here. We did put in the chat, Brian, the white paper that your team has created on the future of work, organizational resilience, and the changing employer-employee relationship. So I know there'll be much more to come on that paper as we kind of expand out and plan some future events around what your team found there and that white paper. So, but that's in the chat for all of our attendees. And, Brian, thank you for the time and effort your consulting team puts into this. I know you mentioned Julie in the beginning there, and just a tremendous amount of work on her part and the entire team. So appreciate it. It's always interesting, ever changing. Look forward to next quarter. And hey, maybe we'll continue to get some good news coming into these, because it's getting a little depressing there for a while. Yeah. So on behalf of HRQ and Landrum HR, thanks so much for joining us today.
Thank you.